Alrighty. So in today's video, we are going to get into the top 3 deadliest credit spread mistakes that you want to avoid like the plague. So let's get into the first one. And mistake number 1 is to hold till expiration. So why is holding till expiration a deadly mistake? Well, there are 3 main reasons, right? The first reason is that there is a risk of early assignment on your in-the-money short options, right? So for example, we have an example of the bull put spread here, which is the put credit spread. So let's say if the market actually goes down, and let's say there is let's say 7 DTE left, so there's 7 days to expiration, then there's always a chance that the market, or rather these short options which you have, could get early assignment, right? If you get early assigned, basically what it means is now you will be long 100 shares, and this is no good because now it kind of messed up your spread, right? You now have 100 shares and then you still have this long put, and it can get a little bit confusing for many people, especially if you're just starting out, right? Because if you want to unwind this, you also need to know exactly how to do it to reinstate your position. So if you want to hold all the way to expiration, this is one of the risks that you have to face, especially if you do not have this capital to long 100 shares. Then guess what? The broker is going to come knocking at your door. All right, he's not going to come knocking at your door. He's probably just going to send you an email to let you know that you have already got long 100 shares. You need more capital. They want you to top up, right? So this is one thing you need to take note of. Now, this is for the put credit spread. If you have the call spread, right, the call spread is on top down here, so I'll put a C down here so you know it's call. So what happens if the market goes up? Now, for the call spread, you also are exposed to an additional risk, which is called the dividend risk, right? Let's say, for example, if the stock which you are trading pays a dividend, then there's a chance that any in-the-money call option has a chance of getting assigned, right? Early assignment. And if you get assigned, what happens is that you're going to get short 100 shares. So this again is pretty scary, because if the stock really shoots all the way to the moon, then you're going to lose money. So basically, this is things that, these are things that can be avoidable. So this is why you do not want to hold till expiration. Now, if you want to hold till expiration, let me just remove all this. If, let's say, for example, the market is out of the money, right? That means it's above your put spread, and you want to hold till expiration. Now, this can be, a fair argument that you could hold to expiration, right? Because there's no risk of any early assignment, because this is not even in the money. And the answer is yes, of course, you can do that and hold to expiration if you want, right? But the thing you need to take note of and always, take account of is that the market could just change directions and go down. So by that time, let's say, for example, there's 7 DTE left and the market is, above your short strike. So you're thinking, oh, all is well, you're going to make the max profit on this credit spread. Then all of a sudden, a news happened, don't know, maybe the Fed said something that is unfavorable, or maybe something happened to the stock. All of a sudden, it crashes down to your short put, it goes past it. What are you going to do, right? What are you going to do? Are you going to exit the trade for a loss? Or are you going to hold on again, and now you're going to have early assignment risk, all right? So this is something you want to think about. The second reason for mistake number 1 is that it actually has a worse performance compared to exiting at 21 DTE. So what's the alternative of holding to expiration? Well, that is to exit at 21 DTE regardless if it's a win or a loss, because as you can see down here, this is a study done by the Tasty Trade team, and I've shared this in a number of my videos as well, but I just want to share it with you again to emphasize that holding to expiration does not necessarily mean that you are going to make more money in the long term, right? It's a little bit deceiving, because you will definitely get more in terms of the max profit. That is, if you actually, have the option expire out of money. Yep. But in the long term, especially if you see this over a lot of trades, especially this is a study that's done over numerous years by the Tasty Trade team, you can see that, the performance is actually not as good as exiting 21 DTE. Right, you can see this is holding to expiration, this is exiting at 21 DTE, and you can see that based on the annual ROC, it's higher, right, for both spreads, whether $5 white, $10 white, compared to holding to expiration. So this is taking into account all your losses as well as all your wins. And one of the main reasons is because when you exit at 21 DTE, you actually massively cut down your average loss, your risk, right? You take a look at your average loss for $5 white and a $10 white. right? You can see they're in a couple of hundreds, right? But whereas if you were to exit at 21 DTE, you notice that your loss is so much lesser. The average loss has been mitigated. So that is why over the long term, you tend to have a better performance. So you do not want to just take like, one trade, 10 trades, or maybe even 20, 30 trades. And based on the results, you give a judgment that maybe holding to expiration is better, right? Remember, we want to always have a large sample size and preferably over 100 or more trades, right? Preferably 500 trades even. Okay, mistake number 2 is having a tight spread. So why is having a tight spread, right? Tight wings, basically it's tight spread. Wings is only if it's for iron condor, so this is tight spread. Why is this a deadly mistake? So what do I mean by tight spread, by the way? Tight spread just basically means, the width of your short strike to your long put option, all right? So a lot of people, or at least I noticed that quite a number of YouTubers are actually talking about trading, those $1 white spreads, $2 white spreads, because they think this is lesser risk and maybe they get more return, right? So the thing is that this is a little bit of a misconception. So I'll explain to you why. So there are 3 main reasons. Well, first of all, and this is the more obvious one, is that you pay more commissions when you want to increase contracts versus one contract with wide wings. So let's say, for example, this is a $2 white spread, right? So let's say this is $2 white, and let's say you have enough capital to trade 5 of this. So what you're going to do is you are going to trade 5 contracts. Now, what's the alternative? The alternative is to, instead of putting $2 white wing, you might want to stretch it to a $10 white wing, right? So maybe now this becomes $10. So when you balance it up, right, one $10 white put spread versus 5 $2 white put spread would have roughly the same risk per trade, right? Roughly the same risk. Now, what happens is, first of all, you will have to pay more for commissions because now you have 5 times, right? Now, secondly, you actually have a lower probability of profit and a worse break-even point. So let's take a look at this. You can see this is the 5 times $2 white put spread. So the probability of profit down here is 63%, and the break-even down here is 188.4. All right, now let's take a look at the $10 white put spread. So the $10 white one, you notice that the probability of profit has increased, right? Roughly about 4%, right? You can see this is 63, this is 67, around there. And our break even has actually been lowered as well. So previously it's 108.4, now it's 187.01. As you can see, it is lower. So you actually get a better chance of making money on this trade, right? On your put spread when you widen it. Now, the third reason, and the more important reason here, is that it's actually riskier than because it's easier to hit your max lot. So $2 white is actually riskier than $10 white. Why is that so? All right, so let's just take a look at the $2 white first and this $10 white put spread. So just by looking at this, which do you think is more riskier? Now, a lot of people will say that the $10 one is more riskier. Why? Because, if the market goes all the way down here, $2 white, you only lose this much, right? But whereas for the $10 whites, you will lose this much. So everybody have the misconception that, hey, the $10 white one, the wider the wings, is much more riskier, stay away from it. But they are forgetting one thing, because whenever you are trading, you always have capital allocation. So capital allocation basically just means, what is the risk per trade? So let's just say, for example, you have about $800 to risk per trade, all right? So $800 to risk per trade, and based on a $10 white, let's say maybe you receive $2 in terms of premium, right? Your risk would be $800. So you would have to trade, just 1 times of this $10 white. Now, what about for the $2 white, right? So for the $2 white, maybe you receive, I don't know, say 30 cents for this, because remember, right now you have a $2 white, so that means your maximum loss is $2 minus off the premium which you get, which is about $170. So let's say about $170 is your risk per trade. Now, when you take into account risk per trade, capital allocation, now you cannot just trade one of this $2 white, right? Because one of this $2 white is only $170. So how many do you need to trade? So you need to take this, your trusty calculator to calculate it. You take $800 and then you divide it by 170, and that gives you roughly 4.7. So let's say, for example, you just round it off, right? Round it off to 5 times this $2 wide put spread. So let's say, for example, the risk is now both the same, right? It's roughly around $800. Now, if you were to take a look at this chart down here, you take a look at this wings down here, or rather the spread, which is easier for you to hit your max loss? All right, let me just remove all this drawing. Which is easier for you to hit your max loss? Obviously, it is the $2 wide, because the moment the market comes here, you will pretty much hit your max loss at expiration. Whereas for the $10 wide, let's say, for example, it expires here at expiration, $10 wide do not actually lose the max loss, because the max loss is past this point down here. So you actually lose lesser. So that is why it's actually much riskier for you to go for a tighter credit spread rather than a wider one. So whenever you have more capital to allocate, you always want to increase the width first, rather than you increase your contract size. The only time you want to increase your contract size is only when you have, increased the width relatively wide enough until this long option down here is maybe around the 5 delta mark, right? So if you were to increase it any further, it doesn't really make any sense. This is when you can see, all right, maybe I want to go 2 of this, right? So this is how you decide whether you go to increase your contract size or increase your spread width. Now, mistake number 3 is going naked. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So why is going naked a deadly mistake? All right, so this didn't come out nicely, going naked. Now, obviously, I do not mean you going without clothes. Of course, that would also be a very deadly mistake if you were to go without clothes. Going naked to trade a naked position, no good, no good. All right, none of that shenanigans. Let's get back to real business. Let's talk about options right now. What do I mean by going naked? Going naked just means that, let's say, for example, the market blows through your put spread. Right now, as you know, your put spread is in a loss. But if you were to break them up individually, let's say, for example, the short put, the short put, will be losing money, right? Will be losing money. You'll be probably losing more money than the long put option. So we put $2 signs here. Whereas for this long put down here, because now you are considered in the money, right? Because you bought a long put, you want the market to actually go down. You are actually in a profit, right? So this put option down here is actually making money. This is losing money. So of course, you're losing more in your short put than your long put. So what some people do is they will try and change the strategy to a short put. So what they do is that they will sell this off for a profit in hopes that the market bounces back up, and then this they can either close out for a profit or they wait until it expires out of money. So this way you make money on both of these strikes, right? On this both short strike and a long strike. Now, this is only good if you know for sure the market is going to rebound. But if the market doesn't rebound and the market goes all the way down to the sewage, then guess what? Your bank account, your trading account is going to the sewage as well. So this is actually very risky, because a lot of people, they try and convince themselves that the market will go back up, or they try and tell themselves, I don't want to take a loss. I don't want to accept this loss, so they do this. And I remember once back then, a long time ago, I used to join one of those rooms where they would have trade calls. And this person, the owner of the trading room, will put on a put spread. So he will put on a put spread. All right, let me just remove this drawing. He'll put on a put spread, and all of a sudden, the market has crashed through this put spread pretty badly. So what he did is he told the group, says that, hey, this is actually a good stock. So basically it's some XYZ stock. And he suddenly says that, oh, I may want to hold on to the shares because I think it's good. So he says, now I'm going to turn this to become a cash secured put. That means now he wants to hold on to the shares, and he will sell off this put option for a profit. Now, this is a big problem. Why is this a big problem? Because remember, there is capital allocation involved. So when there's capital allocation involved, you may have risk, let's say 5% on this trade down here. Now, all of a sudden, when you take off this long put option, Now you're unprotected all the way to zero. Suddenly your risk from 5% will skyrocket to how much? 20%, 25%, or even more. So that is why this is a very big mistake. And I'm going to go through the reasons, right? So this is the first one, which I already talked about. You have already positioned size your trade based on your capital allocation per trade. So when you go naked, now your risk has been significantly increased, right? 5 to 20%. And also don't forget, you do not only have one trade on at any single one time, right? Chances are that you're going to have multiple trades. Now, what if your capital allocation by that time has already reached around 50%, right? So you have already allocated 50% of your total capital into all the different trades that you have on your account. Now, because of this one trade, all of a sudden, it's going to push your total capital allocation to much higher. Maybe become 65%, or even now, maybe even 70%. So you can see this becomes so much riskier, especially right now, there's no long put to protect your position. If there's new trades to put on, you cannot put on. Plus your capital gets stuck, because what if the market stays there forever or it never comes up? Then you're going to have a very huge capital allocation stuck there and you're not sure what you're going to do. So that is why if your idea, your plan to get into the trade meant to be a credit spread, then get out of the trade as a credit spread. You don't want to convert it into a naked position. Now, there's nothing wrong with entering into a naked position like the short put, but you want to make sure that when you enter it, it is as a short put. It is as a naked position, because then you have the proper capital allocation. All right. So that is the first reason. Now, the second reason, again, like I mentioned, your capital is stuck and you might not be able to put on new trades. And now you can potentially blow up your account. So you won't believe how many people actually emailed me telling me that, a lot of their trades have gone wrong. They're not sure what to do. And their account is at risk of blowing up, right? So if you put yourself into that position, well, I'm sorry to say that this is really on you, right? Because when you enter the trade, you already have a defined risk position on. This further down here, this barger down here, this long put is meant to protect your account so that you do not get into this situation to blow up your account. But because you do not want to take the loss, you remove this person that is actually only the only thing that is protecting your lifeline, right? Protecting your whole account from blowing up. You remove this, then guess what? This is really on you right now. You might want to just get out the trade for whatever loss that you can. So you never want to put yourself into this position, okay? Always ensure that when you put it on as a credit spread, stick to it as a credit spread. And more importantly, you have an exit plan to know what to do, right? Your exit plan hopefully is not to get rid of this long put. All right, guys, so these are the 3 mistakes. Let me just go through one more time. The first mistake is to hold to expiration. You do not want to do that. You want to at least exit at 21 DTE. And the second mistake is to have tight spreads, because as you know, tight spreads is riskier because the market is easier for it to, test the long put side, have your max loss hit. And finally, the last one is not to go naked. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.